The IRS recently listed a CRAT, a Charitable Remainder Annuity Trust, as a listed transaction. Now, you might ask, first of all, what's a CRAT and what's a listed transaction? Let's dig into this because it's really important for people that are interested in getting tax savings ideas and acting on them. So let's say you had a situation where you had an asset, you had a bunch of shares of some currency, let's say $100,000 worth, and when you bought it, and now it's worth $1 million. Option one is you sell the $1 million, you have a $900,000 gain. You're going to pay taxes on that. We'll assume it's long-term tax, let's just say, plus state tax. Let's say it's a quarter, 25% altogether. So let's say that would be in the neighborhood of $225,000 of tax you would have in that entire scenario. Okay? So that's option one. That's worst case scenario. All right. And in that scenario, out of that $1 million, you retain $775,000 for yourself, free and clear. How can we beat that? Can a CRAT beat that? The notion of a CRAT is that I gift a big amount of that, the whole million of it, let's say, and I put that into the trust. Right away, I get a write-off, a charitable write-off of $1 million, which I have up to 5 years to use on my tax return. And I'm limited to how much I can write off in a year. Typically, you're limited to 50%, or in this case, it would be 30% of your adjusted gross income. So can I use that? Can I really use up all that in 5 years? That's the first thing to verify, because it's a waste if I can't use it in 5 years. After 5 years, it's lost. Well, a CRAT, a Charitable Remainder Annuity Trust, is a type of trust that has been aggressively promoted by people who promote tax angles. The notion is that you take your funds, instead of cashing them out, you put them into a charitable trust, and you get to claim a write-off of the entire amount as a charitable deduction, or like that portion that's a charitable deduction. And then over time, that trust pays out to the charity of intent. And also you can get some annuity payout to yourself from the interest that's accrued from that. Now, that all sounds well and good and it sells very well, but here's the problem. There are a gazillion different types of trusts. And then when you get into the category of charitable trusts, there are a couple flavors. One is a type of trust where the money goes to the charity right up front. And then there's another trust where it goes to the charity at the end when the trust is wound down. And that's what the remainder word is indicating. Annuity means there's a regular monthly payment that goes to you as the person who created the trust. You get a payment of the interest of the money that's in that trust. Okay. So you're getting some payout of that. What you often hear is lawyers promoting these trusts. You could set this money up and say, I think 10 years, maybe 20 years max. But the problem is a certain ratio of how much the net present value of the trust has to remain in there. If that ever breaks a certain limit that the IRS assigned, then you as the taxpayer become liable for the entire amount and you lose the charitable deduction. You have to pay capital gains tax on everything that went in there, which is worse than before. Why is this important? Well, the advocates of these charitable remainder trusts promote such aggressive returns that it's almost always the case that a buyer of a CRAT ends up violating these minimum net present value rules and ends up in a very bad tax situation. The way the IRS tracks this, because once you set up a CRAT, there's very little to report in your tax return in the following years. So what they do is they require you to report it as a listed transaction. A listed transaction means it's a transaction that's on a list that the IRS has already established. Nothing wrong in and of itself there. It just means that on your next tax return, you have to file a form that identifies that you have a listed transaction. And it's a special form, 8886, and you basically list certain general details about the CRAT on that form. There's no tax associated with reporting it there. You just simply have to report it. Failure to report that you have it is a $100,000 penalty plus 75% of the tax benefit that you gain from it. So it's pretty punitive to not report this. If you get audited, this is where the auditor is going to go straight to that list of listed transactions and make sure that you're in compliance with those, because that's like easy pickings for them. Listed transactions are arrangements that are frequently abused by taxpayers. right? Otherwise, normal legal things to do, but people set up abusive structures like CRATs that can be abused and people run afoul of them. Since you're listing it, you need to make sure that you're in compliance with the IRS rules on that. Hopefully, your trustee will give you a report that reveals that. You need a lawyer to set up this type of trust. Now, here's what happens. You don't realize it when you're getting the sales pitch, but he's suggesting what could be. But these are all very aggressive positions that could result in a violation of the minimum net present value standards of the IRS. The rate for setting up these trusts is they charge around $8,000 to $10,000. Plus, you have annual accounting fees you have to pay to prove that this trust is in a healthy state, and you have to file a tax return on it. Then the $1 million is put into this trust, and you have a lawyer who sets up the trust, and he generally serves as the trust administrator. And it doesn't require much work from him except giving you an annual report. So what happens is when you get to the point where you're violating it or close to violating it, what happens is the lawyer who created the trust, in other words, the lawyer who actually runs the trust, you have to go back to him to restructure the payment streams in order to remain in compliance with the net present value rules. So you're going to rewrite those trust terms, and you're going to get less of a payout, the annuity payout, than you had originally planned on. So if you'd made plans, you're going to get burned. It's a very special type of software to actually calculate these amounts. And typically, this is why a lot of promoters are basically promoting a scam, because they know that they're going to resell that trust 2 or 3 times to you when you have to rewrite the terms. So, they've got you both ways. It usually ends up to be a hostile relationship. Now, in this trust, you set up a payout structure to yourself. Every year, you're going to get paid a certain amount. Let's say you and your trustee, you decide that this trust is going to earn at least 6% interest a year. So that's like, $60,000 a year. So you have 60,000 or just under 60,000 paid to you as a annuity. You get 60,000 paid to you. You're going to have to pay taxes on that. All right, just to be clear. But you get this annuity paid to you. That's kind of nice. Now, you get this annuity from a charity gift. The notion of a charitable remainder trust is that you put the funds in and then it goes as a gift to a charity. The way with a charitable remainder annuity trust, the remainder means that $1 million goes to the charity at the end of the trust. Let's say the trust is set up for 10 years. I think you can go as many as 20 years. Let's say it's 10 years. That means at the end of 10 years, $1 million is given to this charity. Well, because it grows, you're not actually giving $1 million today to that charity. You're giving $1 million 10 years from now for that charity. So what you really have is a situation, well, let's say it's $650,000 of your gift now with interest will be worth $1 million 10 years from now. And so you give it to them. So that remainder amount, or what's not given, the $350,000, that can be given back to you via the regular annuity payments. So what you have is the ability to pay out from that plus the interest, and you have this monthly payout to you, a revenue stream. That's nice. That's exciting. Here's the problem. If at any time, based on the IRS established annuity rates, and they come out with these every year, or every quarter actually, and they say this is what the net present value of things have to be a valid trust. Let's say there's been inflation and these rates go up higher. They go from say 4% to 8%. Well, all of a sudden, it's going to be tough for you to justify or prove that the amount of money you set aside is actually going to have enough money 10 years from now to pay that $1 million. If you ever run afoul of that, the IRS completely unravels the trust, treats the entire $1 million you gave as your own capital gains. You get hit for all the capital gains on that. You get hit for penalties on all that. And they're going to go back and unwind prior tax returns to recover this stuff. And you're actually going to end up paying in taxes far more than the $225,000 that we hypothesized you'd make. All of this to say that a high percentage of charitable remainder annuity trusts get unraveled by the IRS for failing to meet these standards. And in my experience, I've just never seen that these really turn out to be a big savings. If you simply gave money directly to the charity, you get a charitable benefit right away. And you can do it at the fair market value that's out there. Based on slightly varying the assumptions, you can do just as well avoiding the whole trust altogether. I have a video on charitable remainder trusts and the distortions that promoters use, and it's worth anybody taking a look at. The numbers are very complicated. The promoters never show you the numbers, but they will after you've signed up and spent the money, then they'll inform you of the limitations that you're in. You're never going to get what was promised. And once you put your money into that trust, you have effectively lost control of it. So it's far better just to keep life simple.